In this video, you'll learn a breakout trade setup. You'll get some quick background, a setup example, and then trade entry and exit points. This setup is suited for a daily time frame. The trade is entered and exited the same day. When compared to other trades, this setup has a higher than average risk-reward level. Of course, there is risk in all futures trading. Markets tend to run in cycles. Traders use this action and reaction sequence to predict upcoming directional price movement. But what happens when volatility contracts and there is little or no price movement? This calls for a breakout strategy. This setup has two requirements. The first is called an inside day. Here is a daily chart for the E-mini S&P 500 futures. Focus on the relationship between March 28th and 29th. Notice that the high for the 28th is above that of the 29th. Also, the low is below that of the 29th. In other words, the trading range of the 29th is completely inside the range of the previous day. This is an inside day. The first setup requirement is met. The second requirement is that the trading range for this inside day be the smallest of the last 4 days. Here are the trading ranges for the same S&P 500 contract. Remember, the trading range is the distance between the daily high and low. The range for the 29th has contracted considerably. Looking back, we see it is the smallest of the last 4 days. Both requirements of the setup have been met. The 29th is an inside day, and it also has the narrowest trading range of the last 4 days. Conditions are ripe for a breakout the following day. Let's zoom in on the 29th and look at trade entry and exit points for the next day. Our reference points are the high and low of the 29th. We are looking for the price to break out of this zone. Volatility is cyclical. Range contraction predicts range expansion, and when it arrives, it can be significant. But will breakout be above or below the inside day? This setup predicts a breakout, but not its direction. So here's how we enter the trade. A resting buy stop is placed just above yesterday's high. At the same time, a resting sell stop is placed just below yesterday's low. This way, whichever direction the breakout occurs, you'll be pulled into the trade. Let's assume price moves up above yesterday's high. The resting buy stop is activated. We keep the resting sell stop in place as our stop loss. Often, when a high or low is crossed, price will retrace and test that reference point. This is not unusual. If a robust breakout mounts, you'll need to determine at what point to take your profit off the table. If price instead retreats below yesterday's low, you'll be stopped out with a loss. There has been a lot written about distinguishing between a sustainable breakout and a false breakout that loses steam and retreats. That's why this setup carries a high risk-return trade-off. Click below to subscribe and get updates for upcoming futures trading education.